Everyone thinks Alexander Hamilton saved the American economy. They're wrong. 1789. New York. The United States had just won independence and faced a crisis no one could ignore. The government was drowning in debt. The Revolutionary War had cost millions. Foreign creditors wanted payment. Domestic creditors, soldiers, suppliers, bondholders were owed everything. The Treasury was empty. Hamilton, newly appointed Secretary of the Treasury, understood something most didn't. A nation without credit was a nation without power. December 1790. Hamilton proposed a radical solution, the first bank of the United States, a private bank chartered by Congress backed by federal capital. It would hold government deposits, it would issue currency, it would stabilize credit markets. On paper, it was elegant, but Hamilton didn't know what opposition was coming. He hadn't yet seen the fissures it would crack open. Thomas Jefferson hated the plan. James Madison too. They believed the Constitution never granted Congress power to charter a private bank. It was, in their view, a Trojan horse for federal overreach. Hamilton argued implied powers. If the Constitution granted Congress the right to manage finances, the bank was a necessary tool. The two sides weren't debating mechanics. They were debating what the Constitution actually meant. February 1791. President Washington signed the charter anyway. The bank opened in Philadelphia. It accepted government deposits. It loaned money to merchants and landowners. For a time it worked. Credit flowed. The economy expanded. But the bank also created something new, a concentration of financial power in private hands backed by government authority. Rural farmers resented it. State banks saw it as competition. The seeds of a deeper conflict were already planted. The controversy didn't die, it metastasized. By the early 1800s, the bank's charter was set to expire. Congress would have to renew it or let it collapse. Anti-bank factions grew louder. They called it aristocratic. They called it un-American. They said it favored the wealthy and the coastal elite over farmers and frontier settlers. The bank's defenders pointed to economic stability. Its critics pointed to inequality. 1811. Congress voted. The charter was not renewed. The first Bank of the United States ceased operations. Its demise meant something larger. The nation had rejected Hamilton's vision of centralized financial power, at least for now. But the problems the bank had tried to solve didn't vanish. Credit dried up. The War of 1812 exposed the nation's financial fragility. Within a few years, Congress chartered a second bank. The cycle repeated. What happened wasn't a simple victory for democracy over tyranny. It was a collision between two incomplete truths, the need for stable credit and the fear of concentrated power. Hamilton saw the first, his opponents saw the second. Neither was wrong. The first bank existed for only 20 years, but it shaped how Americans think about central banking, federal authority, and the relationship between government and money for centuries afterward. This video is for educational and informational purposes only and is not financial advice. Always do your own research. Subscribe for more forgotten financial histories that shape the world we inherit. This video is for educational and informational purposes only and is not financial advice. Always do your own research.